Let's face it, folks. We've all seen those flashy ads promising instant wealth through trading. They pop up everywhere on your social media feeds, in your email inbox, and even while you're watching videos online. These ads are designed to grab your attention with bold claims and flashy graphics, making it seem like anyone can become a millionaire overnight. They make it seem so easy, don't they? Just a few clicks and boom, you're swimming in cash. The idea of making money quickly and with minimal effort is incredibly appealing. It's like a dream come true, especially in today's fast-paced world where everyone is looking for shortcuts to success. But let me tell you, the reality of trading is far different. Behind those success stories and glamorous lifestyles portrayed in the ads, there's a much harsher truth. Trading is not a guaranteed path to riches. In fact, it's a complex and often stressful endeavor that requires a lot of knowledge, skill, and emotional resilience. It's a high-stakes game where the potential for big wins comes with equally big risks. The stock market can be unpredictable, and prices can fluctuate wildly in a matter of seconds. One wrong move, and you could lose a significant amount of money. It's not just about making the right trades, it's also about managing your risks and knowing when to cut your losses. Don't get me wrong, trading can be profitable, but it's not for the faint of heart. It requires a deep understanding of the markets, a well-thought-out strategy, and the ability to stay calm under pressure. Successful traders spend years honing their skills and learning from their mistakes. They know that there's no such thing as easy money. It takes a deep understanding of the markets, nerves of steel, and a disciplined approach. You need to be able to analyze data, spot trends, and make informed decisions based on your research. It's a continuous learning process, and even the most experienced traders are always looking for ways to improve their strategies. The truth is, most people who jump into trading without proper knowledge and preparation end up losing money. They get caught up in the excitement and make impulsive decisions that lead to costly mistakes. It's important to remember that trading is not a get-rich-quick scheme. It's a serious business that requires dedication and hard work. That's why it's crucial to understand the difference between trading and investing before you risk a single penny. Investing is about building wealth over the long term, while trading is about taking advantage of short-term market movements. Each approach has its own set of risks and rewards, and it's important to choose the one that aligns with your financial goals and risk tolerance. So buckle up and get ready for a dose of reality as we delve into the world of trading versus investing. We'll explore the strategies, the risks, and the rewards, and help you make an informed decision about which path is right for you. Whether you're a seasoned trader or a complete beginner, there's always something new to learn in the ever-evolving world of finance. Trading is all about trying to capitalize on short-term price fluctuations in the market. It's a fast-paced environment where decisions need to be made in the blink of an eye. Every second counts, and the stakes are incredibly high. Traders aim to buy assets when they believe the price is low, often relying on a mix of intuition, experience, and data analysis. They scrutinize financial reports, market trends, and even global news to make informed decisions. The goal is to sell these assets quickly when the price goes up. Buy low, sell high, right? But it's not always that simple. Market conditions can change in an instant, turning a promising trade into a loss. They often use sophisticated tools and strategies to identify potential trading opportunities and manage their risk. Technical analysis, chart patterns, and algorithms are just a few of the methods employed to gain an edge. Think of it like surfing. Just as a surfer reads the waves, a trader reads the market. Both require a keen sense of timing and an understanding of the environment. Traders ride the waves of market volatility, hoping to catch a big one and make a quick profit. The thrill of a successful trade can be exhilarating, but the risks are always present. But just like surfing, trading requires skill, timing, and a bit of luck. Even the most experienced traders can be caught off guard by sudden market shifts. If you're not careful, you can get wiped out by a rogue wave. Losses can be swift and severe, wiping out gains in an instant. This is where understanding the VIX comes in. Known as the fear gauge, the VIX measures market volatility and helps traders anticipate potential market swings. By keeping an eye on the VIX, traders can better manage their risk and make more informed decisions. The VIX, or Volatility Index, is often referred to as the fear gauge of the market. It measures the expected volatility of the S&P 500 index, which is a basket of 500 large-cap U.S. stocks. In simple terms, a high VIX indicates that investors are expecting big price swings in the market, usually downwards. This means there's a lot of fear and uncertainty. Why is this important for traders? Well, volatility is a trader's best friend. The bigger the price swings, the greater the potential for profits and losses. So, traders keep a close eye on the VIX to get a sense of market sentiment and adjust their strategies accordingly. Section 4. Common trading pitfalls. Why most traders lose. Now let's talk about why so many traders, especially beginners, end up losing money. Trading can be incredibly challenging, and without the right approach, it's easy to fall into common traps that can drain your account quickly. First, lack of knowledge. Trading is not simply buying low and selling high. It requires a deep understanding of technical analysis, fundamental analysis, risk management, and more. Many people think they can just jump in and start making money, but the reality is far more complex. You need to understand market trends, economic indicators, and how different financial instruments work. Many traders jump in without a solid foundation, leading to costly mistakes. They might follow tips from unreliable sources or make trades based on gut feelings rather than solid research. This lack of preparation often results in significant losses. Second, emotional decision-making. Trading can be an emotional roller coaster. Fear and greed often cloud judgment, causing traders to make impulsive decisions that can wipe out their profits. For instance, fear might cause a trader to sell off a position too early, missing out on potential gains. Conversely, greed might lead them to hold on to a losing position for too long, hoping for a turnaround that never comes. Third, overtrading. It's a common trap for traders to get caught up in the excitement of the market and make too many trades. Overtrading can be driven by the desire to make quick profits, but it often leads to increased transaction costs and a higher likelihood of making poor decisions. Each trade comes with its own set of risks and costs, and making too many trades can quickly erode your capital. This increases transaction costs and the likelihood of making bad decisions. It's important to have a well-thought-out trading plan and stick to it, rather than getting swept up in the market's ups and downs. Fourth, ignoring risk management. One of the biggest mistakes traders make is not having a proper risk management plan. Risk management is crucial in trading because it helps protect your capital from significant losses. Without it, a single bad trade can wipe out weeks or even months of gains. This means setting stop-loss orders to limit potential losses and not risking more money than they can afford to lose. A good risk management strategy also involves diversifying your trades and not putting all your money into a single position. The truth is, many so-called trading gurus are just charlatans trying to sell you a dream. They promise easy money and quick success. But the reality is that trading is hard work. These gurus often make their money by selling courses and seminars rather than through successful trading. Don't be fooled by their promises of easy money. Trading is hard work, and it takes time, dedication, and a lot of learning to succeed. The best traders are those who continuously educate themselves, stay disciplined, and learn from their mistakes. Remember, there are no shortcuts to success in trading. Section 5. Investing, the steady path to long-term wealth. Investing, on the other hand, is a long-term game. It involves buying assets like stocks, bonds, or real estate and holding them for an extended period, often years or even decades. Investors believe in the long-term growth potential of the assets they invest in and are willing to ride out short-term market fluctuations. Think of it like planting a tree. You choose a healthy sapling, a good company or asset, plant it in fertile ground, a diversified portfolio. Water it regularly by reinvesting your earnings, and patiently wait for it to grow into a mighty oak, a substantial investment portfolio.